Good evening. How are you doing? So welcome. Welcome to Sac State Downtown, which opened officially last fall. And thanks for coming to tonight's discussion. My name is Leonor Ehling. I'm the director of the Center for California Studies, which is sponsoring this event. So who are we at the Center for California Studies at Sac State? We're mostly known for 4 fabulous fellowship programs we run. And 2 of the directors of 2 of the programs are here. Pam Chu of the Assembly Fellows Program, Jamie Taylor of the Senate Fellows Program, the Executive Fellows Program, and the Judicial Fellows Program. Are there any fellows here, former fellows? Okay. So these programs place recent college graduates at the highest levels of our state's 3 branches of government for a year to give them hands-on experience in governing. Very popular, very successful. We have hundreds of applications every year for 64 slots. But that's not all we do. We also serve as, or we try to serve as, a bridge between academia and state policymakers. And we also organize policy seminars like this one and fund applied policy research conducted by CSU faculty. Tonight's topic is about consumer debt, specifically debt from payday loans and student loans. And we're talking about this issue as part of our larger discussion about inequity, inequality, and poverty in California. We know that many Californians face financial hardship on a daily basis. 1 of 4 children in California live in families that lack the resources to meet their basic needs. A significant portion of households spend more than half their income on housing. And in this current atmosphere of tight wallets, payday loans are used by many people to pay for unexpected expenses. But given that 4 out of 5 payday loans are rolled over, we know that payday loans can lead to a cycle of debt that leads to even more poverty. So it's an important discussion. And I'd really like to thank our distinguished guests, our distinguished panelists, for joining us for this important discussion. Here to introduce our panelists is Kat Taylor, co-founder of Beneficial State Bank. Beneficial State Bank is a community development financial institution whose mission is to bring beneficial banking to low-income communities in an economically and environmentally sustainable manner, with the ultimate aim of changing the banking system for good, right? Kat's also a founding director of Tomcat Ranch Educational Foundation, founded to inspire a sustainable food system. She serves on a number of nonprofit boards, is a graduate of Harvard College and Stanford Business and Law Schools, and is the mother of 4 grown children. Please join me in welcoming our moderator, Kat Taylor.
Thank you. Thank you very much for the kind introduction. Is this transmitting well for everybody? Okay, good. So I'm going to thank you in song for having an interest in the financial system. It's our job to make banking interesting. We know it's boring and complicated, but it's super important. So thank you for turning up tonight to learn more about consumer debt and how we can protect Californians from abuses in the banking system, in the financial system. They say that these are not the best of times, but they're the only times I'll ever know. And I believe there is a time for meditation in cathedrals of our own. So when I see that sad surrender in my brother's eyes, I can't stand aside and only sympathize. For we are always what our situation hands us. It's either sadness or euphoria. So we're choosing euphoria. Without further ado, shameless amateur singing. At Beneficial State Bank, we believe banking is a quasi-public activity and that the banking system belongs to all of us. We have accorded significant prerogatives to the banking system in the shape of FDIC insurance, which allows us banks to self-insure and attract deposits at very low cost and quite readily. There are $13 trillion of deposits in the American economy alone, and banking as a result is bigger than any other industry on the planet. We gave that FDIC insurance and the ability to borrow at the Fed window and the ability to lever equity capital with those deposits because we wanted to facilitate the financing of a future in which we all wish to live. But it has gone terribly awry in the last several decades. We started Beneficial State Bank in 2007 on a hunch that there was something terribly wrong in the banking system, and we've been proven right with every insight we gained over the last 11 years. We're now $1 billion in assets, 17 branch offices across the 3 West Coast states with 250 employees. That makes us a very tiny bank in the system, but everybody knew David would beat Goliath in the day. It takes an agile actor to challenge the status quo. We have the great pleasure today of having Richard Cordray and Seth Frotman, who are experts in the arena. Rich was the eminent director of the Consumer Finance Protection Bureau in its glory days, 2011 to 2017. We're going to learn more about what that agency accomplished and why we have now moved to a place where we need one at the state level. Seth is one of the country's leading experts on student debt. He's impassioned on the subject, and I'm going to let him introduce the organization that he's running right now when we get to that. But first, just to allow both of them to frame the issues, we're going to talk tonight about this need for a state-level consumer finance protection authority, about payday lending, what it is, why we need rate cap legislation, and student debt and its interplay with the health of our main economy and the future of our young people. So if I could ask you, Rich, first to tell us a little bit about those glory days of the CFPB, why it was established, what it has accomplished to date, and the state of affairs there now.
Okay, sure. Thanks, Kat. And thanks to all of you for being here. I was the first director of the new agency called the Consumer Financial Protection Bureau. The rationale for that agency was this. We suffered through what we all hope will turn out to be the worst financial crisis and recession of our lifetimes starting in 2007 and 8 and continuing for a number of years. In the wake of that, there was clearly a need for reform of the financial system, and Congress struggled over how to do that. Ultimately, it gave rise to a piece of legislation, a landmark piece of legislation known as the Dodd-Frank Act. One of the ideas buried in the Dodd-Frank Act, which was an idea that had originated with a law professor named Elizabeth Warren. Anybody ever heard of her? She was a law professor, bankruptcy law professor of all things at the time, was that we should have an agency, some unit of the government, some part of the government, focused very specifically on protecting consumers in the financial marketplace. Let me try to describe why that was important. She wrote an article, which was the germ of this idea, in which she noted that we now took it for granted in our society that if you sold people some sort of physical product, her example was a toaster, could have been any kind of physical product, and it turned out to be unsafe for the consumer. We had procedures in place to try to stop that from happening. We review products, we try to make sure what's going on the market, we understand the risks, we test products, we look at them very carefully because we've had enough bad experiences of that sort. But when it came to financial products, so for example, a toaster could malfunction and burn down your house, but a mortgage could malfunction and put you out on the street and cost you your house. What's the difference between them? Well, financial products are less tangible, they're less clear, they're a little more murky, and they hadn't really created a focus among the public at large. But what we have seen happen in the last 2 generations is that what once was a fairly simple process of consumer finance, where there wasn't much credit available to people. I'm thinking back to my grandparents here. Maybe you all can think back to your grandparents. They might get a simple short-term mortgage. They might get a car loan, might not. People who grew up in the Depression hated to borrow money of any kind. They might have some in-store credit, maybe a Sears or Penny's or some sort of credit card that would get you advances on credit for a particular location. But that was about it. We didn't have general purpose credit cards yet. We didn't have all the fancy exotic mortgage instruments that we eventually developed in this country, and all of the consumer credit that's available. In 1962, President Kennedy made a speech to Congress in which he laid out at the time what he aspired to have them pass, which was a Consumer Bill of Rights. It was mostly about tangible products, but he noted that in the last 10 years, he said, the amount of consumer credit in the economy had exploded. That is, the number of financial products. It had risen to the alarming level of being $200 billion in consumer debt that was owed in this country in 1962. Today, that number stands at $13.5 trillion in consumer debt that we owe. It's gone from about $1,000 a person to about $40,000 a person. What that means is two things. It means that the economy has become financialized to a significant degree. The percentage of revenues and employment in the economy that is part of the financial sector has gone from 10% of the economy to 20% over the last 40 years. At the same time, consumer credit is so significant, so much a part of our lives, we rarely make any kind of significant purchase without borrowing on credit. We rarely save ahead for those. And that means that things are more complicated for all of us. First of all, we have all these complicated consumer credit decisions that we have to make. If you have multiple credit cards, you may or may not be aware of it. Maybe you're quite aware of it. They have different interest rates. They carry different terms. You think about which credit card you're going to use for this or that. You think about which credit card you're going to try to pay down first, et cetera. That's all complicated enough. The mortgage market got incredibly complicated leading up to the crisis, complicated enough that a lot of people were baffled by it. They were getting into loans that they had no business being in. They were told that these loans would work for them. They felt that if the person across the table, the expert, the lender, was willing to make that loan, they must have confidence they were going to succeed, because why would they lend me money if they didn't think I was going to succeed? What they didn't realize was often those loans were then being sold off to someone else, wash their hands of it, and it might be years before they would go bad, and then they would be a very different situation. So things have gotten much more complicated for people. The other thing that we fail to really think about is that when we make a big purchase, say a car or a home, we now have two decisions to make all of a sudden. We have to make all the decisions and all the judgments and all the choices about what home to buy or what car to buy, but then we have to make all the decisions and judgments about how to finance that, what kind of mortgage to get, what kind of car loan to get. And what we found at the CFPB when we did survey research was people often spent a great deal of time picking out a particular home, and then they were fairly exhausted to go on and shop carefully for a mortgage. They tended to assume that the product being offered to them was off the shelf, that they were getting the right rate, that they were getting whatever rate was appropriate to their credit score. That often was not the case. In the run-up to the financial crisis, it was quite common for someone to qualify for a loan of, let's say, 6%, and be given a loan for 10%. And the broker and the lender would split the proceeds of the extra 4% between them, and the consumer was never the wiser. These were the kinds of things that were happening. But at the time, we had no agency or nobody whose job it was to look out for consumers and see that they were being treated fairly. And the germ of the idea here was that we should split the regulation of the banks and the financial institutions in terms of regulating them for their safety and soundness, split that off from regulating their conduct toward consumers, and have a better focus on the consumer side. And that was necessary to protect people, but it was also necessary to look out for the economy. Because if you simply allowed financial institutions to maximize their profits, they might do things that were smart in the long term and serve the long-term interests of their customers, or they might do things that exploited their customers in the short term, might not last over the long term, but certainly for quarterly earnings and the kinds of things that create a lot of pressure for these executives, that seemed to be adequate to them, and many of them were willing to go down a road of doing things that took advantage of their own customers to pad the bottom line for the short term. So the Consumer Bureau was conceived as having a singular focus, a very specific mission to protect consumers in the financial marketplace, and that was our job. That's why the Bureau was created in the first place. We had a real challenge because they ordered us to stand up this Bureau from scratch. So we had to actually build a government agency. We were supposed to do it in a year. It took actually several years to do it. And we were supposed to then figure out how to police all of the different consumer credit markets: mortgages, credit cards, auto loans, student loans, payday loans, debt collection, credit reporting, and try to bring some order to what was a lot of irresponsible, unruly lending that was occurring and treatment of consumers. So that was our job. That was what we took on. And to me, it was a very wise decision by the Congress to create this. And then it gave us, as Seth could attest, a very difficult job to do to try to put it all in place.
Thanks, Rich. And I well remember because Beneficial State Bank opened its doors in 2007, and we almost immediately watched the credit markets burn down, the housing bubble burst, and a deep slide of housing values that produced a foreclosure crisis almost instantaneously. So, Seth, I was hoping you could keep in mind that the effect of consumer abuses on the larger economy as you introduce the subject of student loans. Sure. And how you're working on them.
Thank you so much. And I think just to start, I think consumer finance is not boring, and no one should think of it as such. So I implore you to read what I think is the greatest consumer financial protection speech of all time, which is Richard Cordray's remarks to the Michigan State University talking about consumer protection as a civil rights issue, which I have been shamelessly stealing for years without telling him.
You have my blessing, my son.
So as this lays out, and I think I worked at the Bureau for 7 years, and I traveled to something like 36 states and talked to thousands of people. And I think all of that kind of boiled up into one conversation, which is the people I was talking to were just like the people that I knew. No one was buying a house with a duffel bag full of cash or able to kind of pay for the car they needed to get to work with a check. And they certainly weren't putting themselves or their kids through school with what they had in their savings account. For all of these things that we deem essential to the lives we want for ourselves, the lives we want for our family, the American dream, people needed credit. And that's what consumer protection comes down to. I think that's what 7 years of work came down to, which is all of these things that we want for ourselves and our family. Were they going to be the province of just really rich people who could bring that duffel bag of cash in? And the rest of us were just going to get ripped off at every turn, or worse, discriminated against because of their race or their sex? And I think when you boil down to it, what we were trying to do at the Bureau all of those years was just really protect the American dream that we all wanted for everyone else. Because what you saw during the financial crisis, and what we saw especially when we were standing up the Bureau, where people's lives were still very much in tatters, was the ripple effect of all of the predatory actors that were out there. So when we first started, I think a day didn't go by where someone at the Bureau wasn't frantically trying to help someone avoid foreclosure on their house. Mm-hmm. And then what we learned very quickly was that one foreclosure impacted a lot of folks, just more than them. Their whole community, the whole tax base, the whole neighborhood, the whole community, and the whole state. And that's the lens to look at student loans through. So you guys may have heard these numbers before, but if not, there is now $1.56 trillion of student debt in America. More than 44 million people get a student loan bill every month. And essentially, we've added $1 trillion of student loan debt, essentially overnight in the terms of consumer markets. And what we have seen is that is having a dramatic impact on individuals' lives, but then also on their communities. So what does that mean for California? So California now has nearly 4 million student loan borrowers in this state who collectively owe over $130 billion. Just to give you a sense of scale, I was in Maine yesterday. It is not very easy to get from Maine to Sacramento, if you are wondering. And there they are freaking out about the amount of student loan debt they have, which is $6 billion. To give you some sense of scale, the state of California added $5 billion of student loan debt in the last 12 months. So this is having an enormous impact on individuals. So we now see evidence that student debt is impacting their ability to buy a house, save for retirement. People are putting off having a family, what career they choose. And the problem is the ripple effect of all of those individual decisions are having enormous ramifications across the economy and our society. So we're starting to see evidence that student loan debt is driving income inequality, racial inequality, economic and racial segregation, driving the racial wealth gap. And what is particularly concerning is that higher education, right or wrong, has always been this American myth that this is the great equalizer. This is the thing that makes us different. This is how you pull yourself up by your bootstraps, something, something, something. And what we see is instead, because of this massively fueled, debt-fueled higher education, what has been sold and billed to millions of people as their chance for a better life is actually driving the very things that are tugging our society apart. And I'll stop talking, put it back to you, but that's like the first issue. Then there's a whole consumer finance issue, which I think we're going to talk about more today.
Yeah, thank you. And so in the ping pong game, I'm going to go back to Rich to talk about the state of the CFPB today, what happened to it, where the gaps are, and the rationale for a state.
Yeah, and if I could, before I do that, let me just illustrate a little more. So in terms of consumer finance, we have a set of different problems, right? We have the individual problems that consumers themselves face. Any one of us, at any moment, you might run into some problem with your credit card bill, or some debt collector is calling you, and you don't think that you owe that debt, but you can't remember for sure. Or maybe they got you mixed up with someone else, or maybe they say the debt's for $420 and you thought it was for $220, and you have all kinds of problems on your hands. One issue is, how do you deal with those problems? How do you try to put those behind you and put them to rest? A different problem is, what about everybody else who may be affected by a very similar problem to yours? How can you systematically try to root these things out throughout our society? So, for example, at the Consumer Bureau, one of the things we did was we created a consumer response system. So when individual consumers complained to us, we would try to get their complaint handled and resolved. But we also paid attention to the pattern of those complaints. And if we were hearing the same kind of complaints over and over against the same institution, that was our antenna went up, and we would potentially consider bringing an investigation and enforcement action to stop that problem for everybody being affected by it. And by the way, you can always assume that if one person is complaining to you, there may well be 10 or 100 behind them who don't know to complain to you, don't think it'd be worth their while to complain to you, can't quite get it together to decide they're going to deal with a government agency, even though it can be done pretty quickly, et cetera. But then there's another set of issues even beyond that, which is the people who are affected by a problem. There's lots of spillovers. I mean, Seth mentioned it a moment ago. The people who have student loans, you might feel like, well, if I'm not one of those people with student loans, then what do I care? But it affects the economy at large. So, for example, in the run-up to the mortgage crisis, there were plenty of people who got into bad loans for whatever reason. Maybe they made bad choices, maybe they were defrauded, maybe they were misled. And then there were plenty of others who were in perfectly fine mortgages, perfectly sensible mortgages, hadn't borrowed too much, hadn't paid too much for their house. But if they were in a subdivision where some other people were being foreclosed on, their property values were going to plummet. They were the innocent bystanders, right? And I heard Kat speaking earlier today about at the banks, when the credit lines froze up, that put a lot of businesses out of business. They couldn't continue. And people who worked for them were out their jobs. They were innocent bystanders as well. They hadn't participated in any unreasonable borrowing or lending or whatever, but they were victims of this as well. So there's ramifications for the individual consumer, there's ramifications for the broader conduct of financial institutions, and there's ramifications for the economy as a whole. So all of those things are germane here. Now I've forgotten. What was the question I was
So how's the CFPB doing today, Rich?
Okay. Well, the CFPB to me, given my point of view, which is I felt that the rationale for the agency in the first place was to try to rebalance the financial markets so that consumers had more weight on their side of the teeter-totter, if you will. I mean, the financial institutions have all the power and all the weight in Washington. They are the biggest lobbyists in Washington. They are one of the massive industries now in the economy. The financial sector is. They sort of have their way there. And to put government on the side of the individual consumer and kind of give them some weight so that they could get their problems responded to and so forth was, I thought, really important. Some people said that we were too aggressive. I thought we really couldn't be aggressive enough in rebalancing the scales. But what's happened now under the new administration is they have taken a very different view of this. The people who were our critics have come into power, some of them. They have said that we had pushed the envelope and that they should no longer push the envelope. They needed to balance the interests of financial institutions. You'd think that it wasn't called the Consumer Financial Protection Bureau, but the Consumer and Financial Institution Protection Bureau, which is something that I object to. They have pulled back in a number of areas, and they are not working aggressively to support and protect consumers. I don't mean to say that they've given up doing all the things that we did. There's quite a few things that are still going on there. They're still responding to consumer complaints. They're still supervising institutions for the most part, although not entirely. They are much more timid about taking enforcement actions, which I think is important because it deters bad behavior. They're much more timid about regulating industries, which in some cases is a very important way to really change the landscape quickly in an industry. We did that with the mortgage industry. That also happened with the credit card industry, and both of those, I think even the industry would agree, have been significantly reformed for the better so that they are more successful and sustainable over the long term, which is what we should want. But right now the CFPB is in retreat, and I think it is the wrong direction. And at the same time, it opens up, and we've been here today having discussions about what can be done at the state level for states like California. And by the way, there is no state like California. California is the largest state in the country, has the 5th largest economy in the world. And if California decides to step up and take leadership about providing more consumer financial protection here at the state level, that will go a long way to making sure that it's sustained in this country, even if the federal government is not doing its job properly.
Thanks very much. And Seth, maybe you could talk a little bit about the Department of Education and what's going on there.
Sure. So I think student loans is a great example, one example of what Director Cordray talked about, which is, so I kind of ran you through the parade of horribles about the amount of debt. But there's another issue here where we call it insult to injury, right? So there's this historic debt burden, but then on top of that, we subject student loan borrowers to a range of predatory players and predatory practices. So we see everyone from private student lenders to student loan servicers, debt collectors to debt relief scams, private equity firms to for-profit schools, all view that $1.5 trillion as their chance to make a quick buck. And this is why the Bureau was so important in the student loan market, because back in Washington, people who think about education never really focused on student loan borrowers. They were focusing on really important things like access and affordability and equity on the front end. And when we went and talked to them in the beginning, they're like, oh, we don't really do student loans that much. And back in 2007, when we were talking to kind of the consumer advocates and the regulators, they're like, we do mortgage. Like, this has just destroyed the whole economy, come back in a couple years. And student loan borrowers had kind of really kind of fallen through the cracks with $1 trillion on top of their heads. And this is what the Bureau tried to change, where we really felt as if, and this is to Director Cordray's credit, Elizabeth Warren credits, my predecessor Rohit Chopra's credit, really found this needed niche, which was viewing student loan borrowers from a consumer financial protection lens. And the other reason, to address your question, why this was so important is, for years, everyone looked to the Department of Education to kind of solve these problems. The problem with that is the Department of Education is one of the world's largest banks. The Department of Education now holds $1.2 trillion in debt. They have described, these are their words, that they are the largest specialty consumer finance bank in the world. And so the same incentives that you saw on the safety and soundness side are just amplified in the student loan market, where constantly we see the Department of Education have a ton of mixed incentives. The student loan servicers are their contractors. The schools that they allowed to grow to be enormous almost became too big to fail institutions. And the Bureau had a critical role because we had one job, which was to stand up for student loan borrowers. And sometimes that we worked really well with the department. Other times there was obviously some conflict based on our authorities and theirs. But for years, I think we were getting to a much better place where people realized that no longer could the student loan market kind of be the Wild West. And so under the 7 years from 2011 until 2017, the Bureau, through using every tool we had, from enforcement to regulation, supervision, complaints, through even just using the bully pulpit, were able to get back $750 million to student loan borrowers. Then, unfortunately, I guess the way I always like to do this up was being the student loan ombudsman was the best job until it wasn't. And I think that was because there was a fundamental change in policy across Washington, D.C. So the new leadership at the Bureau essentially instantly just stopped doing work on student loans. So it's now been 18 months. There hasn't been a single enforcement action against the student loan company. Even the stuff that we were required to do under statute, such as complaint reports, just haven't happened. There has not been a single public enforcement action or supervisory action against any bank, any school, any student loan servicer, any debt collector in 18 months. And unfortunately, what has happened is the Bureau has stepped back from thinking of itself as an independent agency, which we spent so many hours thinking about how you do that in a town like Washington, where if someone's doing something good, you want to help them, but it was ultimately our job not to be part of any administration or any party. And I've been asked like a million times now, how do you kind of sum up what's wrong? And I think the answer is they have turned, at least just for my little slice of the world, the student loan work at the Bureau away from being independent and essentially just an arm of the administration, just an arm of the Department of Ed. And what we saw over and over again was almost the Bureau was asking the Department of Education for like a permission slip to do the work that we were supposed to be doing under the statute, under what Congress told us to do. And unfortunately, this in many ways leaves an enormous black hole in individual borrowers' lives, but also in the financial system. It's like kind of sketchy because they're not very good about giving information. But based on the hearings the new director had last week, it appears as if the Bureau has just stopped overseeing over $1 trillion of consumer debt in America. And certainly the current Department of Education isn't doing that work either. And I think to Director Cordray's point, this is bad for individual consumers, but this is petrifying for the larger economy, that there's an entire generation who has student loan balances on their books, and they are just battling in a very broken system with essentially no help at the federal level anymore.
And I promise we're going to turn to solutions journalism now. And actually, those student loan borrowers include seniors who have co-signed or signed on loans as well. So it's multi-generational. But in solutions journalism, we don't introduce a subject without a solution to go with it. And so I was hoping, Rich, you could talk a little bit about the prospects for a state-level CFPB or something like that, its ability to do market monitoring, coordination with other law enforcement, maybe even an example of a specific solution for something like payday lending.
Yeah, so Kat and others are building a coalition here to encourage and urge the legislature here to pass into law a state-level analog to the Consumer Financial Protection Bureau focused in California. And we had a chance to meet with the governor today, and he's seemed to look favorably upon this idea as well. And part of the rationale is that with the federal government pulling back and a statute that says very explicitly that state law can protect consumers beyond federal law, maybe because they foresaw just this possibility that maybe there would come a time when the federal government was not zealous in doing its duty, but states could fill in. This is a perfect time for a state like California, which again is so large and so influential and so capable of filling the breach here, to do this. And believe me, what California, if California steps up and fulfills that role, what California says has to be done will have to be done probably pretty much around the country, because the notion that you're going to be a mortgage lender, a nationwide mortgage lender, or a nationwide bank of any kind, and you're going to, kind of work around the California market, which is 40 million people, it's just not likely to be the case. So you could have a race to the top. If California is going to be implementing consumer protections or enforcing them in a way that the federal government's not willing to do, California could not only lead for Californians, but it might lead for all Americans. And that would be a very dramatic and important thing for California to do. So we are pushing for, there is a bill in the legislature, it's rather preliminary bill at this point, but would say in essence that California should have a state level agency that would be focused on this very same goal with these very same objectives in mind. And that would be a very good thing. So let's think about what that might mean. It might mean that, for example, if the federal agency, and this is in fact happening, one of the things that we did when I was there was we passed, as one of my final acts on my watch, a strong rule nationally to rein in excesses of payday lending. These are the short-term loans that can be given to people at interest rates that are 200, 300, 400% annualized, really loans that are going to wreck people's futures, not build those futures. That rule right now is being rolled back by the new agency. But California has the opportunity to step into the breach here and impose restrictions on payday loans. Has not done so for years and years, but there's a move afoot in the legislature to do that. That would be important. Or, as Seth has been describing, and he can describe more what's being done by some states around the country, but California is one of the states that's now taking the lead in recognizing that it can give itself the power, and has done so, part on his urging, to oversee student loan servicers. And I just want to reinforce one of the points Seth was making. The people who already owe this debt, this more than $1 trillion in debt, what does that mean? That means every day of their lives, they have this debt hanging over their head. Some of them very significant amounts of debt. It may be 5 figures, it may be 6 figures of debt. They're constantly, month in, month out, trying to figure out how they make those payments, how they meet their other obligations. It matters enormously how they're treated by the people who are in charge of collecting those debts from them. If the student loan servicers have their own agenda, or if they're trying to make money off of this, and of course many of them are, there may come times where, for example, you're trying to pay your student loans down and you want to have your highest interest student loan paid down first, but that may not be in the student loan servicer's interest. Maybe they're just sloppy, or maybe they're self-interested about making sure that you take as long as possible to pay down your loans, because as long as you're doing that, you continue to do business with them. So it matters enormously if we are overseeing the student loan services and making sure that they're treating people well and doing things that are in the consumer's interest. California is starting to step in to look at this now that the federal government has stepped back away from doing that. But it matters enormously to the people's lives who are subject to that debt in terms of whether they're going to be able to succeed, whether they're going to be able to optimize their finances, how it will affect the other trajectories of their lives, which is really important.
And Seth, I wonder if you'd amplify a little bit about relief measures it could be for those already indebted, and the borrower's bill of rights that might protect future borrowers.
Sure. So a couple things. As Director Cordray said, this state has really been on the forefront of standing up for student loan borrowers. So in 2017, Assemblymember Stone passed one of the first bills that would require student loan servicers to get a license and be overseen by the state. Here, DBO would do that. Then Attorney General Becerra sued Navient, arguing that the company had failed every type of borrower with every type of loan at every stage of repayment, which is not hyperbole. And then there's a new measure, a new effort afoot that Assemblymember Stone is championing to build and create essentially a borrower's bill of rights, to take a lot of the gaps that student loan borrowers struggle with because they don't have the same rights and protections that other folks have, build those into state law, and then put in place a really strong enforcement mechanism to make sure that borrowers have an avenue either through public enforcement or private enforcement when those are broken. Just a couple points I want to make and hijack my time. So I think you mentioned older Americans, and I meant to say this up front, right? But a lot of what you hear around student loan debt is that this is some sort of like avocado toast eating issue. I'm not sure if you guys have heard this, but this is just a generation that deserves everything they got because they eat too much avocados. I don't know what it means, but nothing could be further from the truth, obviously, but also it does a really disservice to all those who are struggling. So we have some stats. So now nearly 500,000 older Americans in California have student loan debt. Nearly 500,000 student loan borrowers in the state are actually live in rural areas. So what you see is, obviously, is $1.5 trillion. It impacts a lot of people. But the traditional notions of like people who got in over their heads because of bad decision making is obviously not true. So I think the other piece that's really interesting about the California Consumer Bureau is, in addition to being the student loan ombudsman, I was also the assistant director for the Office for Young Consumers. And obviously a huge chunk of our time was spent on student loans. But we also tried to do some more thinking about the unique challenges that young consumers face in the marketplace. Especially because everywhere I went, and when you go outside the little bubble of DC, kind of the number one thing when you would talk to borrowers would be, I'm not just my student loan. Like, I have other aspirations, but I also have other financial obligations. And what we see of like the generation born of the financial crisis is petrifying. So the rates of auto loan delinquencies amongst younger borrowers are astronomical. They're particularly hit hard by overdraft. And then something like a third of millennials now have taken out a payday loan. So what you really see, and I think the kind of really exciting piece about a consumer bureau, and I think one of the things that made the bureau so special was kind of pulling aside the artificial limits that regulators and enforcement agencies usually had, right? So the bureau could go after and oversee and regulate an institution regardless of whether it was a bank and took deposits or if it was a non-bank institution. And then also what you see at the state level are really defined areas of jurisdiction based on product. So you could go after payday, but you can't go after auto title. The Bureau kind of broke down all of those barriers and said, essentially, if you're a financial institution, you're engaged in making consumer financial products and services, the Bureau is going to have jurisdiction over you. And what I think the potential to think about in California is how you have a government that's responsive to people who have very messy financial lives and aren't defined by the product they are, and certainly not defined by whether they took out that product from a bank or a non-bank, but giving the state the ability to be responsive to not only people, but also the challenges that they face with the full range of tools is something that I think has the potential to really change the game in terms of consumer financial protection.
Great. I'm going to just make a few comments and give these guys a rest while you maybe think of questions you might like to ask. So first to say that at Beneficial State Bank, we believe in government. We believe it's potentially the only accountable institution and that we should support it. You will hear commonly from banks that they may feel over-regulated, that there's regulatory overlap or the burden is too great and so on. But we don't really give credit where credit is due, because if we regulate financial markets well and we stop these predatory products, it actually makes those honorable banks among us, it makes our job easier. It's not a race to the bottom. We're not competing against fraudulent products. When Washington Mutual offered free checking, it cost on average every checking account holder $500 in fees every year. You try to go against that in a marketplace, it's really difficult. So we embrace our regulations. They're very important. In banking, we're not only regulated to be safe and sound, we're regulated to observe fair lending, to prevent discrimination in loan markets. And we know that there is persistent racial discrimination in the mortgage markets, in small business lending. We are regulated to prevent money laundering, to protect customer privacy, to prevent cyber security breaches, and so on. These are all critical societal functions. Banks produce societal outcomes, not just economic ones. So we should be very careful to keep them regulated and accountable to the public. A special shout out to Assemblywoman Limon, who is the head of the House Banking Committee. She is the sponsor of a bill to stand up a state-level Consumer Finance Protection Bureau or something equivalent. And she also has a bill to impose a rate cap on payday loans in the state of California. So these are brave positions to take. It's been hard to pass those sorts of things. The industry lobby is massively powerful. The ABA has the 4th largest PAC in the United States now. So with that, I'm open for some questions for Rich or Seth.
Hi, my name is Stephen Weiss. With the rise of AI, clearly a lot of people are going to have to go back to school for retraining or to change directions in their careers. So with that, it seems like we're going to have to double down on the double down and protect those people as well. So I guess it's not really a question or it's a question of, like how can you protect those people?
Yeah. So no, it's a great point. I think so. One of the things that we tried to do when we were allowed to do them was convince everyone that student debt was their problem, right? So there's 1 million people in DC thinking about the future of work. And there was a guy running for Virginia, for governor in Virginia, and this is totally taking his line, but it was great. It was, so everyone's telling us that in, some amount of time, we're all going to have 6 different careers or something. And the question is, how do you do that if you have $150,000 in debt from the first one, right? And I think it's a great example about how, we need to think through the role of student debt when it comes to everything. And I think we need to think through the role of debt-fueled higher education when it comes to everything, because if there's really going to be this massive structural change in the economy, like, it just doesn't work with the current economics if we actually expect people to go back to school, get jobs, get another job, go back to school. And it's a great question because I don't think it's on that many people's radar.
Seth, how about debt-free college propositions, debt forgiveness?
Sure. So a couple things. So one of the things we spent a lot of time on at the CFPB was because people were even starting to talk about college affordability and debt-free college all the way back in 2011 and 2012. And it's remarkable because what you would see, especially at a lot of like campaign events and public forums, is some poor person would raise their hand and say, I'm really worried, I have $80,000 in debt. And then whoever the politician was would be like, let me tell you about my free college program. And like they would like pan back to the person who is a combination of distraught and angry because that obviously does nothing to help their life. So what we always had a little leeway to say, even at the government, was you can make college free tomorrow and it would do nothing for 44 million Americans. And they really need to be both sides of the same coin when we talk about public policy. I think that the really interesting questions around college affordability, debt-free college, tuition-free college, is the idea that we haven't really factored in the true cost of what student debt has. So there's all of these discussions about how we shouldn't worry about student debt because you make $1 million more if you go to college than if you don't. And this is called the college wage premium, which now I'm not in government, I can say whatever I want, right, is the most disingenuous and dangerous stat in all of higher ed. Because what you see is that $1 million doesn't exist because college-educated folks' lives are getting better. They're actually quite flat. The reason why college is so beneficial now is because the bottom has fallen out of a non-college educated workforce in America. But we continue to have this debate where people shouldn't be worried about debt, people shouldn't be worried about college affordability because you get this $1 million. And I think where it all ties together is talking about the true cost of student debt, I think is actually really helpful in the free college debate, because I think that the average state legislature, who's critically important to these discussions, is trying to do the right thing. There's enormous financial pressures, and they're trying to figure out if you fill potholes or give money to higher ed. And they hear the same things we do. And they're like, oh, what's an extra $10,000 in debt? All of you are going to make $1 million extra bucks. But that's just not true. And until we actually give them a lens to realize what $10,000 or $20,000 means for their constituents and their communities, I don't think we get the political will to pass any of those. And I think that's like some of the critical work that you hope to happen even with the dark times in Washington, are academics, researchers, advocates kind of documenting the true cost of this so we could have solutions for those who have debt, but then actually provide a roadmap to realize that the current path we are in is just not working.
Thanks. I'm Chris Schultz. I'm the Chief Deputy Director of the California Department that regulates professional licenses. And I guess my question is about, in California, we have a high standard for consumer protection, and that often higher than other states. So that might mean in California, we require 1,600 hours to become a barber or cosmetologist, or it might mean we require more continuing education hours than other states would require. Do you have any thoughts about whether professional licensing or these continuing education requirements force students into more debt than is absolutely necessary?
Yeah, that wasn't really an issue that came before us at CFPB, but I do have reactions to it, thoughts about it. We have significantly licensed lots of different fields that may or may not really be justified. And I think that a broad review of those would be helpful, because there's always an incentive for people in a field to want to pull the ladder up after them and say, I'm in this field now and I want everybody else to have to get more criteria in order to join me in this field, and if they don't, then I have more of a monopoly and prices rise and my wages rise. That goes part and parcel with, there's lots of people in different jobs now that are being subjected to non-compete covenants. Even you're seeing them in fast food, where you can't work in fast food in like a 15-mile radius. You don't really need, I worked in fast food, it's my first job, true of a lot of people. You don't really need any training for that job. The only reason to do that is to make it harder for other restaurants to take your people and to suppress wages. So I think some of these things, these are different kinds of public policies than we were dealing with the Consumer Bureau, but they're worthy of review and really thinking about in terms of whether we're helping, who we're actually helping. Are we just helping the inside group in that field, or are we actually helping the public at large? Not clear to me that we are. And if it means people are having to take on unnecessary debt to get certain credentials that may or may not be that germane to their performance in a field, then almost certainly we're creating economic waste.
Hi there, my name is Benjamin Trent, born in the tail end of the so-called avocado generation. So I grew up with immigrant parents and therefore had to take on a lot of the burden of finding out the financial literacy and understanding of how to fund my own college education. I think my question is, how do we continue to expand financial literacy and improve it so that people truly understand what they're getting into when they do take on student debt to get an education?
I'll talk about that a little bit, and then if Seth wants to talk about it a bit more. I personally have a very strong belief, it was reinforced by my time at the Consumer Bureau, that we do way too little in our country today to educate people about the financial challenges they're going to have to face when they get out on their own as adults, as we all have to do. And by the way, we now require pretty much everybody before they graduate from high school to have civics and U.S. history, because it's thought that that creates, a fully participant citizen in our democracy. But you also can't be a successful person in our particular form of democracy with a free market economy unless you can survive economically and manage your financial affairs and not end up in bankruptcy and essentially ruining your life because of financial problems. So I personally believe that every state in this country ought to require every student before they graduate from high school to have some form of financial literacy training. If they don't get it there, where are they going to get it? They're going to get it at home. They're going to get it from the parents that may themselves be struggling with these issues, and by the way, often find it very difficult to talk about these issues with their children because it's a sore spot for them or a source of tension in the household because they're, struggling to make ends meet. Are they going to get in the workplace? Do we actually provide that kind of remedial financial training in the workplace? Good employer, that might be part of their benefits package. That could be a useful thing. Might make their employees better off, but you don't see a lot of that. So I don't see anybody getting it in America other than out in the school of hard knocks, which means they go out, they repeat the same mistakes people have made before them, they suffer the consequences, and then they learn. I mean, the whole point of education is everybody else has already suffered the consequences. Let's learn from them without having to suffer the problems ourselves. I think that's incredibly important. The other point I was going to make about what Seth is talking about in terms of student loan debt, there's also quite a lot of debt that people pile up to pay for college and to pay for education that isn't per se student loan debt. People borrow against their houses, people put things on their credit cards. Probably the total amount of debt being accumulated to pay for education is even considerably higher than the 1.56 trillion that he mentioned. So this is really an enormous problem in our society. And as he says, when you think about the ripple effects, how much it's affecting people's lives, the albatross around a lot of young people's necks. And by the way, those are our best and brightest, our most successful young people who find their way to college and manage to get through, although many of them end up not graduating, and that's the worst of all. They've accumulated the debt, but they don't have any kind of premium, whether real or imaginary, to sort of help them pay it off. So it's a big problem.
And then the only thing I'll add is, I think some of the work we did at the Bureau was just such common sense and just so straightforward to help accomplish the goal you were talking about, which is, I think it's kind of a two-step process. Borrowers and consumers and everyday people kind of need to know what they're on the lookout for, but then they have to have the tools in place to actually kind of shop around or to know what they're looking for. So we spent a ton of time thinking about how you actually create a mechanism so people could shop for a mortgage. And we try to do this when it came to schools, where I'm not sure if you guys are familiar. So you get into a school and you get a financial aid award letter. And those things are horrible. Like we looked at, and this is still going on now, where you look at some of those and it's impossible to tell what is debt. And like borrowers could take out tens of thousands of dollars, but like the bottom line says zero because loans are packaged with grants, et cetera, et cetera. So sometimes it was kind of a bizarre world at the Bureau where everyone was like saying we were doing all of this, really aggressive or over the top stuff, when we were trying to just put in place like really basic tools, which were, if I go to college, how much debt will I take on? Right? Like, if I'm going to make a purchase for a very expensive mortgage, how do I shop around? And I think that's like some of the really fun and interesting stuff we worked on in the Bureau was, if you can create an educated and motivated group of consumers, how do you then actually give them the tools to be successful? Because I think those are two really important pieces. You could have consumers who kind of know everything they want when they walk into a car dealer or get a financial aid award letter. If all of that information is hidden, or if it's deceptive in the legal or non-legal way, it's still not helping anyone. And I think that was some of the fun work we had at the Bureau, was how do you actually empower people themselves to make better decisions?
Hi, I'm Rosemary Shahan. I'm President of Consumers for Auto Reliability and Safety, and we're based here in Sacramento. And first thing I want to say is thank you, Richard Cordray and Seth Frotman, so much for all the work that you did at the federal level. And God knows there are a lot of us out here who really, really, really miss you. There's no question that Mick Mulvaney and Kathy Kraninger, let's just say, they're not you. And so I wanted to ask if you could talk about two issues that are near and dear to my heart. And one is arbitration. And I know you issued the arbitration rule, and a lot of us fought tooth and nail to keep it. And it got down to Mike Pence in the Senate. And yeah, so there's that. And also, could you talk about the Office of Service Member Affairs at the Bureau? And, you know, California has more active duty military either stationed in or deployed from our state than any other state. And they can be really great allies in pushing for consumer protections because they're very diverse, they're very vulnerable for a lot of reasons. And so could you talk some about the importance of protecting military as consumers?
Yeah. I'll take arbitration. I'll try to do it fairly quickly, then I'll pass service member to Seth, who, although I don't think he mentioned it tonight, worked in that office for a couple of years as part of his tour of duty at the Bureau as well. On arbitration, you know, there are a lot of laws passed by Congress that say in certain areas that if you feel that you were treated unfairly or that the law was violated in a way that hurts you, you can sue in court to try to get relief and be made whole. All right. And in a lot of areas, it doesn't really make sense for you individually to sue in court for your own injuries unless you can go together with everybody else who's been injured similarly, which is called a class action. I'm sure you know what that is, but just in case others are less familiar. And in the area of consumer finance, that's quite important because very often you'll have harms done by, say, a bank where they make a systematic error. And it may only cost you $40 or $50 or $100, but it might have been true of millions of different customers. So all told, the bank has profited by $40 or $50 million. You wouldn't bother to go to court to sue to recover your $40 or $50. There was a judge once who said about this, only a lunatic or a fanatic sues for $50. Sometimes people are mad enough that they will do it. But the right thing in that situation is to do a class action. This is a mechanism Congress created and blessed that said that if people are hurt in a similar way, they can go to court together, band together, and get their injuries remedied, and then relief will be sent to all of them individually. The arbitration situation was that based on a statute that goes back to 1929, which actually had to do with business-to-business arbitrations originally, and it's now been transformed into consumer arbitrations as well, which I think it had nothing to do with, says that if the fine print of the contract says specifically that if you are injured, you can't go to court, you have to go to arbitration, and the company typically sticks that into the contract. You don't have any say about it. If you want to buy the product, you have to, sign on wholesale to whatever terms they're offering you. Then you're deprived of your right to go to court. You have to go to arbitration. The arbitration may be a process that's stacked by industry in a way that you'll rarely get a good result. By the way, it'll also be an individualized result, so again, you lose the incentive to go at all. The Congress had looked at this, and they had said that arbitration clauses that cut off people's rights to pursue class actions were outlawed for mortgages. So it tells you something. Congress had already thought that's a bad idea there. And it said about the whole rest of consumer finance that the Consumer Bureau should do a report on arbitration clauses, document what you can about what the pros and cons of those are, and based on what you find in that report, consider writing a rule to modify the treatment of arbitration clauses. We did a report, 752-page study, as I recall, quite comprehensive, looked at data nobody had looked at before, found that the benefits of arbitration vastly outweighed the costs. And so we wrote a rule that said that arbitration clauses could not be used in these contracts to cut off people's right to go to court for class actions. And the industry went fairly crazy about that, and they pushed the Congress to overturn our rule, which is the only time that's ever happened in consumer finance. And as you say, it came down to one vote in the Senate It got in a late night vote. It got to a point where the vote was 50-50, and Mike Pence came across town in his motorcade and cast the decisive vote to overturn our rule. What that means is that what we tried to do on arbitration clauses is not law of the land now. But as Barney Frank told me a couple days later, he believes that when we have the opportunity, that will be legislated across the board, not only in consumer finance, but right now, if you have disputes over a nursing home, the fine print might say that you can't go to court over those disputes. If you have disputes in the workplace where your civil rights are being violated, you're being discriminated against based on sex or race or pregnancy or whatever, those can be cut off in your employment contract. It's really quite an unfair practice. And the notion that businesses can, by the stroke of a pen, wipe out protections that Congress has provided for in laws, and Congress has somehow stood for this and accepted this, tells me that we've moved a far ways away from any notion of fairness in our society. I do think that will be legislated eventually. We'll have to flip the Senate and the presidency first, but that could happen pretty soon.
So on the Office of Service Member Affairs, to take one step back, so the crafters of Dodd-Frank and the people who stood up the Bureau realized that for unique populations, they often had unique challenges in the consumer finance markets. So they created an office for service member affairs, an office for older Americans. They also then stood up an office for students and young consumers. And I thought this was one of the most creative and far-reaching impacts of the Consumer Bureau, because what we saw was those jobs, which I am partial to because they kept me gainfully employed over 7 years between the Office of Service Member Affairs and the Office for Students, was one, it created a mechanism to get on the road and talk to people and realize what their challenges were, which were often quite different than what was happening in Washington. So for 4 years, I worked for Holly Petraeus, who's an American hero. And this was, again, the mortgage crisis was still raging and was having these particular impacts on service members. And everywhere we went, we heard about service members who were not deploying, but were doing something called PCS moves. So in the Army and the military, most people move almost every 3 years. The problem was that a lot of service members, for many reasons, own a home, and they bought this home at the top of the crisis. Then the crisis happened, and they were told they needed to move out of their house in Nevada or some other place hit extremely hard, and this was just wreaking havoc across the military. So back in Washington, everyone wanted to talk about deployments, bankers and congressmen. And Holly, because she's Holly, they would start down their PowerPoints and she'd be like, I don't want to talk about this. Like, we're going to talk about what I want to talk about because that's what is happening. And because it was Holly, she marshaled the entire federal government to essentially realize that this was a problem that they needed to address. And you saw that consistently where the Bureau was talking about issues no one was talking about because we actually had these offices who thought about these issues and talked to real people. The second role of these jobs were to be fierce advocates inside the Bureau for these populations. So if there was a mortgage rulemaking, you could bet they knew they had to talk to Holly about what the challenges that service members were facing or what were the issues that older Americans were facing. And I think one of the things that's really interesting is as you think through what a California Consumer Bureau could look like, is thinking through the centrality of how these offices could work, but then not be limited by what the Bureau wanted to do, but also what's unique to California. Should there be an office for rural borrowers? Should there be an office for new Americans? And I think it kind of goes into this rightful concern, which is this was such a fierce advocate, what's kind of happening now? And I think a lot of your efforts are really exciting because I think we would all feel a lot better if we had like a backstop and like something here in California to be like, oh, Washington isn't working on this, but we know there's like some floor because we have our folks doing it. And so as you think through, it's a great question because I would certainly encourage you to think through how awesome those specialty offices were.
Time for one more question.
And by the way, even when we get to a point where Washington again might be working in this area, there's nothing wrong with having supplemental efforts by the states. We don't have enough work being done in this area as it is, and probably never will.
One quick question. Thanks for being here. Anita Kermis, Director of Financial Aid at Sac State, and I think no, it's all good. I think I drank the Kool-Aid about 30 years ago, because I've been in higher education for about 30 years, and so I'm like feeling bad for all the students that I've helped get through school. Good news on the student loan debt. There's a handful of states, unfortunately only a handful of states, and California, that was one of them, that were implemented last year, and we'll do it again. We're required to send a student loan debt letter to students. So I'm hoping, we did that back in the 80s at the first institution I worked at. It's a wake-up call once a year that's like, holy crap, because kids don't pay attention to how much they're borrowing until they're out of school. It's just like they go, and I got to get through, and this is what I'm doing. But a couple of thoughts I had, because always is like, you have a lot of repayment options. So there's that, and I'm curious to hear how you think about just the various repayment options. Are students not aware of it anymore? And my only other question was, there's so many, it's a complicated problem, right? And so now we may never see another renewed higher education bill, but hopefully one day. They're talking a lot about skin in the game with institutions. Do you think that'll help the loan debt problem, I guess, too?
So a couple things. So on repayment plans, Director Cordray was talking about this. So one of the things that we really focused on, and what was really frustrating, is that Congress in many ways has done some good stuff to try to help student loan borrowers. The number one thing being the creation of essentially an affordable repayment plan. If you guys know mortgages, essentially it's like a mortgage mod on steroids that you have a guaranteed right to. So if you have a federal student loan, which is now 9 out of 10 loans in America, you could pay not based on how much you owe, but based on how much you earn, and that could be as little as 10% of your income. And if you lose your job or have an income shock, you could pay $0 and still be in good standing. The problem is that the protections that borrowers are entitled to are incumbent upon the student loan companies getting those borrowers enrolled. And that's where there's this huge mismatch, where there's an enormous opportunity for regulators and states to step up. Because what we've seen, and so we had an event at the Department of Education, then Undersecretary Mitchell, talking about this issue. And he said, we have enough tools in place that there should be 0 defaults in America. Just to show you how far away we are from that, there are now 8 million student loan borrowers in default. There was another 1 million student loan borrowers who defaulted last year, the year before that, the year before that, the year before that. And at the center of it are protections that borrowers should have, but the servicers aren't helping them. And in a lot of ways, they're doing so illegally, as by the Bureau's lawsuit, by California's lawsuit. A couple things just to flag for you on the horizon. So the industry is not happy that they are being sued, of course. And their solution is the system is just really too complicated for us to implement. Never mind that we're getting hundreds of millions of dollars to do so, and we're gladly taking that money. It's just really hard to help the people who we promised to help. So some of the solutions you see are simplification, which means just taking away borrower benefits, which doesn't seem to solve the problem. So I think I would, as a financial aid, that's what I'd be really worried about, are critical protections that borrowers need, and in an effort to kind of bail out servicers or come up with an easier solution, are simply just going to make life harder for borrowers, but easier for servicers. On the skin in the game piece, so I think that this is interesting but worrisome, because the general idea is a school should have some skin in the game, and if their borrower either defaults or doesn't do well, no one's really figured out the metric, then the school has to eat some of the risk. And I think it's intriguing. The only concern I have is the people I trust who've really studied at this are really worried what it means for access. Our schools who, not this one, but our schools who are in a lot of trouble and hot water for already trying to skim off affluent borrowers or non-Pell? Is it going to drive an either further cycle where if you think that borrowers who deserve and need more than anyone kind of a good path to higher education, but could be riskier based on a million factors, is it going to lead schools to not enroll them? And I think that I've never heard a good answer about why we shouldn't be worried about that.
Well, thank you very much for the questions. Maybe we could give a round of applause to thank Rich and Seth.
Thank you very much for coming. Just want to say special thanks to Claire Bunch, Nadia Navarro-Brown in the back, Stacy Smith, Ken Spence, and the fabulous Steve McKay from Sac State Creative Services. This has been recorded. The recording will be on our website, and I hope you'll pass it along. Thank you very much. Thank you so much. Appreciate it.